Following several years of weak performance, the UK economy expanded by only 1.3% last year, extending a pattern of underwhelming growth. The pace was so sluggish that real GDP per person actually declined during the second half of 2025. So far, the 2020s are shaping up to be even more disappointing than the already lackluster 2010s. It marks the poorest decade for growth in many years. While the global economic environment has been challenging across the board, the UK has been lagging behind its peers, with Germany seemingly attempting to mirror Britain's relative slide. The broader picture is one of near stagnation in real GDP per capita. And even if there are a few early signs of recovery, most households are struggling to see or feel them. When I asked viewers to describe the UK economy in a single word, the most common response was stagnant. And to whoever voted for great, I admire your optimism. Longtime viewers may be tired of seeing this familiar chart of UK productivity growth. Yet in a single image, it captures what has gone wrong since the financial crisis. The result has been lost output and foregone incomes estimated at roughly £10,000 to £12,000 per year. When productivity stalls, living standards typically fail to improve. That connection is hard to escape. Still, after years dominated by pessimism, there may finally be a few tentative positive signals emerging. Surveys show manufacturing output increased last month. Productivity appears to be inching upward. Consumer spending was relatively strong in January. Inflation is forecast to ease. Interest rate reductions are now being openly discussed. But are these isolated positives simply selective highlights that distract from much deeper structural issues? For those hoping the narrative is shifting, there are cautious indications that productivity may genuinely be starting to rise. The Resolution Foundation suggests that if we set aside unreliable labor market data, the UK could actually be experiencing a sustained improvement in labor productivity. Somewhat ironically, the most encouraging development in the UK economy may not even be visible in official figures, because the labor force survey data has proven too inconsistent. Still, let's set that complication aside for a moment. Before celebrating any supposed new economic dawn, it's worth examining why productivity might be picking up in the first place. One explanation, paradoxically, is rising unemployment. Firms are reducing headcount and slowing recruitment, particularly among younger workers. Partly due to a higher national minimum wage, increased national insurance contributions, the growing impact of AI, and possibly a slowdown in net migration. Under these pressures, businesses are being pushed to extract more output from their existing workforce. This dynamic has contributed to a modest improvement in productivity. However, it has largely been driven by cost-cutting rather than significant new investment. And there's reason for caution. Institutions like the OBR have repeatedly forecast productivity rebounds in the past, only to be proven overly optimistic. It takes a bold forecaster to claim that the long-standing productivity stagnation has finally been overcome. Another factor behind higher unemployment is a decline in economic inactivity as more people re-enter the labor market. There has been considerable public anxiety about a supposed generation disengaged from work. It is true that claims for sickness benefits have increased in recent years, yet overall inactivity rates are actually trending downward and remain lower than they were historically. Two key factors help explain this shift. First, although unemployment is rising, it is still far below the levels seen in the 1980s and 1990s, when it frequently exceeded 10%. Second, fewer women are having children and remaining outside the workforce. That trend incidentally contributes to declining fertility rates, though that's a discussion for another time. Together, these developments are offsetting the increase in long-term health-related inactivity. Even so, illness continues to weigh on productivity and puts pressure on public finances, as elevated benefit spending remains a significant fiscal concern. The latest report from the Bank of England presents a mixed picture. On the positive side, the bank has significantly revised down its inflation forecasts. It now expects inflation to fall to around 2.1% by the summer. This outlook is partly driven by lower energy prices, with at least half a percentage point of the decline linked to measures introduced in the last budget. However, while inflation is projected to ease, the downside is weaker expected economic growth. Wage growth in particular appears subdued, and overall output is forecast to rise by just 0.9% in 2026. That effectively points to yet another year of stagnation and possibly even declining disposable incomes once housing costs are taken into account. The overall outcome, then, is that we may see one or perhaps two interest rate cuts, but nothing substantial enough to deliver a meaningful boost to economic momentum. While lower headline inflation is certainly positive news, it's important to remember that the bank has previously underestimated deeper, structural inflationary pressures, particularly within the services sector. In that respect, the UK has stood out, consistently experiencing higher inflation than many comparable economies. Budget interventions can temporarily trim the headline inflation rate, but they do little to resolve the underlying, longer-term inflationary forces simmering beneath the surface of the UK economy. Andrew Sentence, for instance, has argued that the bank has tended to be overly optimistic when forecasting a lasting decline in inflation. In reality, inflation has fallen more slowly than the bank anticipated 2 years ago. What's more, households continue to hold relatively elevated inflation expectations, hovering around 4%. There remains a widespread feeling that, regardless of what official forecasts from institutions like the OBR suggest, the cost of living crisis is far from finished. Many people perceive everyday expenses to be rising sharply, in some cases, faster than the published inflation rate would imply. At the same time, energy costs continue to weigh heavily on industrial output. The UK has some of the highest electricity prices in Europe, and that poses a genuine concern for economic competitiveness. Increasingly, electricity prices reflect substantial fixed costs tied to grid infrastructure and network maintenance. A lesser-known dynamic is that as electricity demand declines, as it has in the UK, partly due to deindustrialization, the average cost per unit actually increases because those large fixed costs are spread across a smaller volume of electricity sold. It's an uncomfortable reality that expensive infrastructure is pushing electricity prices higher, compounded by falling energy demand and reduced industrial production, both notable features of the UK economy since around 2009. Another structural concern is that recent growth has leaned heavily on increased public spending and stronger wage growth within the public sector. Yet public sector productivity has generally lagged behind improvements seen elsewhere. This is partly explained by the inherent difficulty of raising productivity in labor-intensive sectors such as healthcare. For sustainable long-term growth, the UK requires significantly stronger business investment. However, the most recent quarterly figures were disappointing, showing a 2.7% decline in investment. That said, if you step back and examine the average over the past 12 months, there are at least some modest signs of improvement, with investment trending upward overall. Meanwhile, the minimum wage has played a major role in lifting earnings for lower-income households. However, it is now among the highest globally and is increasing at a faster pace than productivity. The potential downside of this imbalance is weaker employment growth, particularly among younger workers. Whether this trend is driven primarily by the minimum wage or by the rapid advancement of artificial intelligence remains open to debate. What is clear, however, is that many young people are facing an extremely challenging economic landscape. Record levels of graduate debt, soaring housing costs, and a shortage of well-paid employment opportunities. Youth unemployment has risen to concerning levels. Even so, while younger cohorts may be under pressure, not all UK households are financially stretched. Despite a slight recent decline, the household saving ratio remains relatively elevated by historical standards. This indicates that at least some households possess untapped spending capacity. The British Retail Consortium reported a 2.7% increase in consumer spending in January. Much of 2025, however, was marked by destabilizing speculation surrounding budgets and potential tax increases. Once the budget uncertainty subsided, some of that anxiety began to ease. The hope is that greater stability may encourage a return to more normal patterns of economic activity. A crucial question for 2026 is whether the UK will avoid a return to the constant pre-budget speculation that has been so damaging to business confidence and consumer sentiment. I would like to remain optimistic. Yet over the past 2 years, negative fiscal shocks have outnumbered positive developments. NIESR, along with many other forecasters, remains cautious about the OBR's projections and anticipates higher deficits and rising debt levels. So what might an optimistic scenario for 2026 look like? It would likely involve political stability, an absence of further tax increases, gradual improvements such as lower interest rates and rising real wages, developments that could unlock pent-up consumer spending and stimulate both public and private investment. Such a combination could generate a positive multiplier effect, boosting tax revenues, easing pressure on the chancellor, and gradually improving the broader economic outlook. However, achieving that scenario would require a series of favorable developments aligning at once. Unfortunately, the most reliable forecasts are often those that predict continuity rather than transformation. Entrenched economic slowdowns are notoriously difficult to escape. From what I can see, the prevailing mood remains subdued, and perhaps understandably so. After accounting for housing costs and taxes, disposable incomes for many households are projected to stagnate or even decline over the next 5 years. That poses a significant challenge. It is difficult to sustain strong economic growth when people feel financially worse off. And the global backdrop offers limited support, with persistent tariff risks and relatively subdued international growth adding further headwinds. Oil prices have recently dropped to their lowest levels in several years, which certainly provides some relief. However, there's no assurance that this relatively favorable environment will last. In recent years, economic shocks have become more common and more unpredictable, and it wouldn't take much to push the UK economy off its current, fragile path. So while I've identified a few tentative signs of improvement, it is still very much early days. Looking at the broader landscape, terms like stagnation and expensive still feel like accurate descriptions of the UK economy. Yes, there is a possibility that conditions could improve, but for many people this falls into the category of "we'll believe it when we see it." Earlier in the video, I touched on the decline in economic inactivity, partly linked to fewer women having children. That shift carries significant long-term consequences, not just for the UK, but globally, as fertility rates continue to decline across much of the world. In another video, I explore whether this demographic trend is ultimately positive or negative. For now, thank you for watching. If you found this helpful, do subscribe, and I'll see you in the next one.